Welcome to Invested Insider, your trusted source for the latest financial news and insights. My name is Amelia Hawthorne, and today is the 31st of July of 2023. Today, we're diving into the complex and consequential world of economics, with a specific focus on the housing market and the ripple effects of its dynamics on the larger economic landscape. We begin with the U.S. housing market, which is on a bit of a bumpy ride. Moody's Analytics has issued a forecast indicating a projected 2.4% decline in property values in the U.S. next year, citing the burden of rising mortgage rates as the culprit. This comes on the heels of a steep increase in mortgage rates over the past year that has, in their words, brought an abrupt end to the real estate boom. While the housing demand remains robust, especially among maturing millennial households, the significant increase in U.S. mortgage rates is causing notable retreats in certain markets. Particularly hard hit are western states, where the property market is experiencing a bit of a downturn. But what has caused this sharp increase in mortgage rates? Well, to combat high inflation, the Federal Reserve embarked on an aggressive campaign, approving 10 rate hikes in the span of 15 months. These actions have had a direct impact on borrowing costs for home equity lines of credit, auto loans, and even credit cards. So, the picture is getting clearer. A rapid rise in mortgage rates translates into increased borrowing costs. A study from LendingTree paints an even starker picture. It found that these higher rates cost borrowers hundreds more each month, with potential additions of up to $75,000 over the lifetime of a 30-year loan. This change in financial dynamics is affecting both potential homebuyers and existing homeowners. Those needing to refinance or with variable payments now face materially larger monthly loan costs, with only modest changes in their incomes. It's a bitter pill to swallow for those caught in the crosshairs. Let's move on to interest rates. Just last Thursday, mortgage buyer Freddie Mac reported that the average rate on a 30-year loan fell to 6.78% from 6.96% the previous week. But let's not celebrate just yet. This rate is still well above the 5.54% recorded just 1 year ago, and certainly a long stretch from the pre-pandemic average of 3.9%. Now let's bring the Federal Reserve back into the conversation. The Fed approved another rate hike of the federal funds rate to a range of 5.25% to 5.5%, which is the highest level since 2007. Policymakers suggest that further increases may be in the cards this year, so we're unlikely to see rate cuts anytime soon. So where does this leave us? Moody's indicates that as central banks begin to shift to a neutral policy stance, the room for decline in long-term rates, including certain mortgage rates, is limited. This is due to long-term, risk-free benchmark yields likely to continue hovering around current levels, assuming the central bank successfully reins in inflation without tipping the economy into a recession. Other factors like the Federal Reserve's unwinding of its $2.5 trillion mortgage bond portfolio, higher credit concerns, market volatility, or fallout from bank balance sheet stress could delay the decline in spreads vis-a-vis benchmark yields and the benefits for mortgage rates. Now, here's where things get even more interesting. Despite higher interest rates, home prices haven't fallen significantly. This can largely be attributed to a worsening inventory shortage, with sellers reluctant to sell as they locked in low mortgage rates before the pandemic. This creates a scenario where the inventory of houses is not keeping pace with demand, leading to an artificial inflation in house prices. Sellers who secured lower rates are hesitant to move on, and potential buyers have fewer options, leading to a market imbalance. The situation is undoubtedly complex, and the repercussions are felt across the economy. The intersection of housing market trends, monetary policy, and broader economic factors create a web of cause and effect that's far from straightforward. As the situation continues to evolve, it's essential to stay informed, weigh your options carefully, and make financial decisions that align with your long-term goals and financial capabilities. For now, that's all we have for today's episode. We hope this discussion has been informative and helpful. As always, we encourage you to do your research, keep up with the news, and make informed decisions. Stay tuned for our next episode where we will delve into more finance topics that matter to you. Until then, this is your host signing off.
The Invested Insider podcast does not offer any financial, economic, legal, accounting, or tax advice or recommendations. The information provided in this podcast or on the associated blog should not be construed as investing or financial advice and should not be considered professional advice. The views, opinions, and content presented in this podcast do not represent the endorsement or approval of Invested Insider and assumes no responsibility for the accuracy or completeness of third-party materials or content referenced in the podcast.